All right. The first question was an update on your banking system report, Emil, that you had of the total global banking system and where the risks were, if you had an update for that at all.
I do have it. I don't have it handy, but the idea is basically that the BIS puts together 5 early warning indicators for private credit expansion. They say it's not public debt that's going to unsettle and roil the system. It's private credit that will then cascade over into the rest of the economy, potentially. And so they put together 5 different early warning indicators, and they update it quarterly, but not in a very handy way. Some of the reports you have to put the data together into your own model. So it's a little frustrating. But basically, South Korea continues to run hot. And that's what all of their indicators are based on, is your economy, your consumption of private credit relative to your history. And if you're well above your trend, then they say there's a 50% chance of a systemic banking crisis sometime in the next 3 years. And they put the Switzerland on there, and that came true a couple of years ago, right? South Korea's on there all the time. And I can't think of anybody else. Hungary kind of pops up, which is kind of strange. Perhaps anybody here on the call can mention if they've heard anything strange about Hungary. But that's what I can come up with off the top of my head.
Yeah, Emil, the biggest thing was, it was, as you said, private credit, not necessarily public credit, which was sort of the unique characteristics that they were coming up with, because almost nobody really thinks too much about private credit, except maybe in some certain settings like China. But as far as public credit goes, or private credit goes, there were a whole bunch of countries that I can recall that were sort of at the limit or near the limit. So while South Korea was up there, the one that many people, the one that the indicators identified, it was hardly the only one that was sort of in the danger zone, if you will.
I've got the list. I pulled it open. Okay. So as of the end of last year, South Korea, Hungary, Canada, Switzerland, Hong Kong, Turkey, Norway, Israel, Sweden, Australia, Finland, and Czech Republic, or Czechia. Those were the ones that were popping up on their list. But Korea, well out in front, Hungary, and then Canada. There you go. Keep an eye on.
A good chunk of the developed world. That's the sad thing.
It's not a foolproof system. These countries have been on the list for a few years now. So it's not once you show up on the radar screen, it's going to happen imminently. It's just something to keep in mind for the next 3 years.
Well, doesn't it also state that, we're talking about too much debt for lack of growth, and that there's an element of efficiency or inefficiency in the metrics? All right, Eric from EPB Research. How are you doing, Eric? Thanks for joining us.
I'm good, Jeff. Thanks for the invite. It's good to be on a panel. I know Mike a little bit. I don't think I've ever been on a panel with Brent or Emil, so good to be with you guys.
Nice to see you.
Absolutely. Great to meet you finally.
Josh, you want to roll the next question?
Yeah. So the next one is, what would cause the long-term debt to increase while the short-term debt decreases if the Fed is cutting rates? So do you see a scenario take place where basically the 10-year blowing up, but the Fed's cutting short-term rates?
So you mean the 10-year rate goes up while the short-term rates go down?
Yeah.
Well, that's kind of the normal pattern. When you get into the recession mechanics, when you get into the recession itself, short-term rates go down and eventually long-term rates settle out. And as the market starts to predict and forecast the recovery period, the long-term rates start to steepen. So that would just be the normal pattern for any type of business cycle.
Well, the answer they're looking for, though, is 2 separate components, right? One is that the front end is always going to be subject to the Fed, right? They control the price of it as long as they supply adequate reserves to keep the level up or pull it back in terms of setting the level of yields. You'll see the front end fall. The question is focused on the back end. Effectively, this is somebody who's saying, what could cause the intense bear steepening that everybody keeps hyping, or the idea that the bond vigilantes are going to show up and suddenly demand 7% compensation for US 10 years. I think that's what they're focused on. Jeff, do you have a thought there?
So in other words, the Fed's cutting rates because we're in a recession, and then suddenly something happens where everybody's selling long bonds for reasons that have nothing to do with recovery or economy. And so that really isn't a question about the short end. It's as you're saying, Mike, it's really a question about what would trigger the market to suddenly start caring about U.S. government deficits or something else. I think the answer would be more along the lines of inflation rather than it would be some kind of business cycle. It would be some kind of secular something long run about, okay, the federal government finally does hit some magical deficit, or there's some kind of trigger in the banking system that suggests that whatever long run deflationary situation we've been in for the last 15, 16, 17 years, something flipped, and now the banking system is starting to take aggressive risks that becomes potentially inflationary. But sort of that kind of regime change, I don't think that would ever happen. Like you're saying, Mike, the market doesn't really care about government deficits for a very, very specific and very good reason.
Yeah, that would be my answer as well, which is I think that there's, a piece came out on Twitter today written by Stephen Moran of the Brookings Institute, in which they were highlighting the excessive and aggressive tactics by the Treasury to avoid the issue of long-term bonds, 10 years and out. And after all of the hoopla, after switching from a 20% issuance of bills to basically 100% issuance of bills, their conclusion was that they had increased the 10-year rate decreased the 10-year rate by 25 basis points. The precision is absurd, but much more important to that is it took all that effort to get 10s down 25 basis points in your analysis, and theoretically people are telling us that this preference of bills over bonds is what drove a 40% rally in the NASDAQ. It just, the whole thing feels kind of silly.
There's always a preference for bills over bonds, and it has nothing to do with any specific time period. There's
a scenario in which that's not true, right? And so one is a very low level of bills in which you have a steep upward sloping curve, but everything's operating from a low level and you can finance those bonds. That's one of the problems right now. You talk about bond demand, nobody can actually finance it. So everything has to be actual dollar cost. And people understandably are looking at this and saying, well, I just got taken for a 30% loss in my long-term bonds. I'm not entirely sure I want to get back in the water. Whether that maintains itself or not is a totally different question. My hunch is that as soon as the Fed cuts rates to the point that the yield curve starts to steepen again, you're going to see everybody and their brother stepping out of the yield curve.
Stepping out of the yield curve?
No, stepping out on the yield curve.
For duration. Yeah, absolutely.
Right.
Yeah, I think also for this scenario to play out, you would almost have to have the Fed abandon their 2% inflation target. If they decided to raise their target to 3% or 4% or just abandon it altogether, then you could have a situation where, they're lowering rates on the front end and the long end is rising due to inflationary concerns or whatever it is.
Who says they haven't done that already?
Well, maybe they have. Yeah.
Jim Rickards, thanks for joining us.
Hey Jeff. Bob, a great group. I wasn't sure who all the panelists were going to be, but I'm pretty much in awe. Although I've spoken with you before, but I never thought I'd get to meet the real Emil Kalinowski. But here's my chance.
That's what everybody says. I still get comments all the time on the YouTube videos. I like the show better with Emil on it.
Yeah, but just on a serious note, to Brent's point and your point, June 2023 CPI headline CPI was 3%. Last month, basically June 2024, it came out at the beginning of July. It was 3%. It bounced around a little bit. It's kind of in a range of 3 to 3.7 with a central tendency of 3.3, but it's been there for 13 months. And you can talk about 2%. Yeah, that's what they say. But, I see 13 months with a central tendency of 3.3%. Who's to say that's not the goal? There's that expression. It's been around for a long time from originally a complexity theorist, but you're starting to hear it more in the popular discourse. The point of a system is what it does.
Sort of like a bureaucracy.
Yeah.
The purpose of a system is what it does. Pause it with.
Exactly. Josh, you want to bring out another question?
Yeah, the next one is probably going to take up the rest of the time.
All right.
And I know Mike Green's going to be excited based upon what we were talking about before we went live. But what do you guys think the biggest risk to the economy is right now that could potentially do a black swan event, or the exact words?
A black swan. Anybody want to take a shot at this one?
It's obvious, though, isn't it? It's not economic. It's geopolitical. It's social. It's beyond the economy. We're living it. Jim, that quote you just said about the point of the system are the results. I just heard that quote for the first time today, and it struck home to me. And I think we have to look beyond the economy. We have to look to the government getting involved for ill or well, and events beyond markets, flowing into markets.
Yeah, I mean, credit where it's due. That the first one that came over that line was Samuel Beer. But in the past 4 weeks, we've had 4. Call them black swans if you want. I never like the expression black swan. I get it. I read all the books and all that, but it's a metaphor that is kind of content free. I like metaphors where the metaphor is actually pretty good mapped to the reality. But that said, making allowance for that, Joe Biden's faceplant in a debate, just, I mean, beyond, garbled words or whatever, just, it speaks for itself. Followed by the assassination attempt on Trump. Then the convention, when they picked J.D. Vance as the VP, I can't think of a more powerful, articulate, and intelligent opponent of the neoliberal consensus and globalism than J.D. Vance. And then followed by Biden withdrawing from the race, which last happened in 1968, but not with 106 days to go. So if you said any one of them could be defined as a black swan, I think that's fair. We've had 4 in like less than 4 weeks. The market didn't care. I mean, stock markets, whatever, Dow's 41,000. I don't know, just chugging along. Gold's, a little higher, but in a range. Interest rates, the yield to maturity and 10-year note came down a little bit, backed up. That's normal. See where it's going. But you can't, if you were just looking at the markets, you wouldn't see anything that said we've just been through one of the most tumultuous and uncertain periods in the political history of the United States. So I guess I'm kind of answering the question where the question is, I don't know what it's going to take to get markets, upset or volatile or shaken up a little bit. But I guess my definition of the black swan is the thing that's not on anybody's list. Meaning, I said Biden was going to be out. I wrote an article on that 10 months ago, and and others did as well. The assassination attempt, that is really bizarre, tragic. Someone was killed out of the blue. J.D. Vance, he was on the short list, even if he's the globalist least favorite dinner date. And so these things, they were in the air, but they were still there were shocks when they actually happened. But it's probably something that none of us have thought of. That'll do it.
I think, to an extent, we've all been kind of acclimatized to that level of political uncertainty and change. So it almost doesn't merit anything other than, okay, yeah, that happened. And I think if we step back and take a look at it from a top-down perspective and hopefully a rational perspective, then you're sort of like Emil was, like, holy crap, this is actually happening here. But we've kind of been seeing it coming along the way. So I agree with you, Jim. It's not really a black swan. It's sort of a continuation of the same process. So if we continue along the same process, thinking like you and Emil are, where does that leave us? So the black swan is not the process. The black swan is the unexpected turn closer to the end of that process. So what would that be?
Well, it'd be $5,000 gold for one thing. I
knew you were going to say that.
Well, but just to clarify a little bit.
I don't disagree with you, by the way.
Yeah, the value of gold never changes. So $5,000 gold tells you nothing about gold. It tells you a lot about the dollar. And people who are expecting some kind of dollar crack up because of budget deficits, and I mean the real harm of a high debt to GDP, high 133%, highest in U.S. history, et cetera. The harm of that is not that there's a sudden repugnance in the treasury market, or treasuries collapse, or interest rates go to 20% or whatever. The harm is slow growth. And Jeff, you've written about this, and I think you and I arrived at this separately, but we both said we've been in a depression since 2007, and people say, well, a recession is 2 consecutive quarters of declining GDP. I mean, that's the heuristic. So a recession sounds worse. Depression sounds worse. So that must be 20 consecutive quarters of declining GDP. But that's not what a depression is. A depression means depressed growth. If your potential is 3.5%, and you're growing at 1.5, 2, that's a depression. That delta between, I'll just say 1.5 and 3.5, extended over a period of 10 years. And we've certainly had that at least since 2009. I mean, the average annual growth from 2009 to 2019, just like right up to the day of COVID, was 2.2%. Compare that to 1983 and 1986, coming out of that recession, we had 16% real growth in 3 years, over 5%, about 5% a year compounded. So, and that's a lot of recovery factors there and unused capacity and all that. But long-term potential is kind of 3.5 in a mature economy. If you're growing at 2, that's a depression, and that was Keynes' definition. So good enough for Keynes. It's good enough for me. But he said a prolonged period of below trend growth with no tendency to either collapse or get back to trend.
Yeah, that's the thing. You just kind of get stuck in it. And it's even worse in emerging markets because, number one, the growth rate still sounds impressive because you're talking about an average 3 to 4% growth. But 3 to 4% growth is half of what it was in the pre-crisis era. You can't go from 8% of a developing world down to 4% and not expect, like we see all over the world, where the global south is trying to move north.
Right.
The Great Migration is simply a consequence of this kind of the depression, as you're pointing out, is, as Emil called it, the silent depression, which is the perfect name for it.
Yeah,
and that leads to all of these other consequences that we're dealing with too. It's another one of these symptoms that we've become normalized to it.
Yeah, I mean the strongest growing, fastest growing major economy in the world right now is Russia. So like nice job on the sanctions, White House. But they're growing like 7%, which is kind of above potential. So they got a little inflation problem.
Hey Jeff, can I ask Senor Gammon a question? Can I turn it around to him? What we've just been discussing, because presumably this is for a U.S. audience. But he's living outside of the country, so he may have a perspective that all of us are just inundated with U.S. information all the time. George, what about you? What?
I think George is going to come back
George
later.
is gone, but you can roll it over, and Brent will answer for him.
Well, can we cut that out of the show? We're not live, are we?
This is kind of like Hollywood Squares. Send it to the block below you.
Well, I'm happy to jump in here because, again, I don't know. By definition, I don't know what the black swan would be, right? If we're all looking at it, then it's not a black swan. But what I would say is I am much more worried about a contraction in the Eurodollar market than I am about something in the U.S. And if something did happen significant in the U.S., that is what would lead, in my opinion, to a contraction in the Eurodollar market. And then that's how you get contagion, right? And so for the most part, despite high rates, we have fairly good global liquidity. Money is not impossible to come by right now, but I think we all know that can change very quickly. And as soon as that changes, for whatever reason, liquidity is the most important thing. Liquidity is always the most important thing, but it's even more important when it isn't there, right? And so, I think Jeff, probably better than anybody that I know, has been pounding the table on this for, I don't know, what is it, 10 years, Jeff? 15 years?
Too long.
Too
Back
long.
when I didn't have
exactly.
hair. Yeah. Well, let me ask.
I'll jump in and add something there, if that's all right, Jeff.
No, go ahead, Barrick.
I'm just a business cycle analyst. I'm far from a geopolitical analyst or
you're selling yourself a little bit short there.
I have absolutely no idea what the black swan could be on that front. But I think generally what we're discussing is an economic shock that hits the economy and what the impact would be. And from a business cycle perspective and using my business cycle framework, what I would add to the conversation is that when the economy is in a period of accelerating growth, or even better, accelerating and above trend growth, the ability to withstand economic shocks or black swans tends to be pretty strong, meaning that if a shock hit the economy when there was a period of accelerating growth, it may cause a disruption in financial markets, but those opportunities usually close up pretty quickly. They're bought, and the market usually rallies and makes a new all-time high. The example that I would give to that would be Brexit. Brexit was absolutely a black swan. Hardly anyone predicted. I think Jim may have predicted that one, but by all accounts, it was a black swan, and there was a dramatic response in financial markets. I think the pound fell 20%, the S&P fell 10%. I think maybe in 2 or 3 days, but the global economy was starting a reacceleration off the back of China manufacturing and industrial real estate stimulus. So the economy kind of took that shock in stride and continued on, and it had several good years after that. The situation that we stand in today is quite a bit different than that, in the sense that the economy is decelerating, growth is objectively slowing, and the best evidence for that would just be the directional trend in the unemployment rate has gone from 3.4 to 4.2. So should a shock come during this state, it would make the economy much more vulnerable to falling into a full business cycle recession as a result of that.
And then what are the consequences of that? Because then you're talking about not just, rising unemployment. I think that if you're talking about really the black swan, I mean, Mike, what does that do to the stock market? Because there's so much tied up into at least the narrative of the stock market too. What happens there?
Well, I think absolutely that becomes kind of the reason that is given, right? So we all know the story of 1929. The depression was caused by the crash of 1929, right? That's absolutely absurd. The economy was running on fumes at that point anyway. It was a symptom rather than the outcome. And I think, unfortunately, you'll see the same type of dynamic here. I'm not suggesting that the Great Depression is directly ahead of us, because that, exactly to the point that Eric is making, requires a series of mistakes along the way. And so there's no guarantee we'll do them, although we certainly seem capable of making every mistake in the book. The amazing thing to me is that we actually know that we've made these mistakes, right? We know that a much, much higher interest rate policy is actually expanding the federal deficit as compared to slowing the economy in a meaningful way that would allow a repair of private sector balance sheets. We know that we've transferred wealth to those who have a low propensity to spend, et cetera, and that's inflating a lot of the stuff that we're seeing. I continue to think that ultimately the real story becomes when the flows start to unwind into passive. We still haven't seen those yet. The frightening thing to me is that the academic researchers a brand new paper came out July 14th from Marco Salmon at Harvard that literally outlines everything I've been talking about and says there's no buyer lower, right? So that sort of break, that sort of loss of wealth, that sort of, to Jim's point on a Posywid type system, right? When the system breaks, if you don't immediately step in to repair it, which my sense is at this point the Fed would view that with an element of relief, right? Because they would think it was disinflationary, or they would think it would solve a problem. I think that's really what we're looking at here. And then the flip side of that equation is I would agree with what Brent is saying on the Eurodollar market or the rest of the world. I think the great irony is everybody looks to an incoming Trump administration to be extraordinarily business friendly, and yet they're talking about extraordinary tariffs that would deprive the rest of the world of access to dollars. People mysteriously wonder about liquidity when we're looking at the U.S. trade deficit having turned significantly negative at the same time that we're financing at a ridiculously high rate given the level of interest, given the level of inflation that we're observing. These things play through, and we take away all those supports. We try to cut the U.S. trade deficit. We try to cut the U.S. government deficit by shrinking interest rate yields. and various forms of spending. And all I see on that front is a massive reversal of the liquidity dynamics that Brent was referring to.
Michael, I'm interested in why you suggested a dichotomy between business friendly and tariffs.
Oh, there's no question that tariffs are business friendly in terms of domestic business, right? The question then becomes, what are all the exceptions you're going to grant for various points along the supply chain in which they're incapable of currently providing for themselves? And once you make those exceptions, how do you then decide who are the favored few who are going to continue to benefit under protectionism? Because that's really what the game is.
But why is it protectionism? It's really mercantilism.
Oh, well, mercantilism is protectionism. It's just for the domestic market.
Well,
right? You're effectively trying to maximize the return of, stop and think about mercantilism in a fiat system. You're trying to maximize the return of dollars to your own country when you print the dollars. That's just absurd.
well, the dollars don't have to come back. They can just be generated here. I don't care what China has in their reserve position. I mean, that's their problem. I hate to sound like John Connolly, but it kind of is their problem. But the point is, what if your base case, the starting place for policy, but by the way, I happen to be working on a pretty large paper on this, so sorry to be, don't mean to sound tedious, but this is what Trump is doing and the brains behind it. Trump gets it, but the big brains behind it are Robert Lighthizer and Peter Navarro. And fortunately, Peter got out of jail in time to, have a place in the West Wing. They're going back to this goes back to 1789, or 87. George Washington, Alexander Hamilton, and what Alexander Hamilton called the American School. Later, Henry Clay picked it up in the 1830s, called it the American System, sometimes the National System. The greatest advocate, believe it or not, or the guy who did the most, like actually implemented this, was Abraham Lincoln. So there is this thread. And then the other side of that were the Jacksonian presidents, Andrew Jackson, Martin Van Buren, and James Knox Polk. I like Polk's one of my favorites because he doubled the size of the country. But he was in the agrarian Jefferson, Madison school that said, no tariffs and let's not promote business. Let's not promote mercantile interests. Let's kind of be an agrarian society. And the Civil War put an end to that because obviously the business interests won. But the best articulated version of it I've heard, I'm kind of getting to your point about incomes, was from William McKinley. And he said, who says this is a zero-sum game or a negative-sum game? If you have protectionism and if you promote industry, incomes will go up. They'll be able to buy the agricultural produce. They'll be able to buy what the miners and the loggers and the farmers are producing. And it's a win-win situation. It doesn't mean you can't have any international trade, but a base case would be, 100% tariffs on everything, and then work backwards to exceptions. And, there are strategic exceptions. But the idea is, hey, China, not to pick on China, it could be Malaysia, Thailand, and anybody else. You want to sell in the United States, fine, invest here. Hire our workers, put the factories here, and we'll make it and sell it in our country. It's a big market, biggest in the world, but that's the deal. And the idea is you don't, because the neoliberal consensus and the globalist consensus says, hey, if you throw, and you're already hearing this, you hear it every day, hey, throw in tariffs, it's going to be inflationary. But McKinley made the point that it's not inflationary if people have higher incomes. In other words, price may go up, nominal price may go up, but if incomes are going up faster, and again, I hate cliches, but sometimes they work. When Henry Ford gave his workers a raise, they go, hey, why'd you do that? You're not exploiting the workers enough. He goes, I want them to buy my cars, and I want them to have enough money to do that. So but we can debate it. Actually, it's a really good debate. It's been going on for a couple hundred years, but this is what Trump's doing. And Lighthizer, remember, he's a veteran of the Reagan administration. He's the guy who crushed the Japanese car industry. Well, really saved the U.S. car industry by putting tariffs on Japan, and then Japan eventually, got with the program and acquiesced with what the U.S. wanted. And Navarro is even more of a hardliner. By the way, quick aside, everyone's talking about Project 2025. That's this Heritage Foundation Mandate for Leadership 2025, nice 900-page summary of what the Trump administration is supposed to do. But I mean, I've read a lot of it, not 900 pages, but there are over 100 contributors, 100 institutional contributors and 100 individual contributors. So it's not a Heritage Foundation product. They're acting as a clearinghouse for a lot of good ideas. So you got Claremont Foundation, Hoover, everybody's pitching in. Of course, the Democrats want to demonize it. There's plenty of red meat for the Democrats. So that's what you're hearing about. But there's a new book. I don't have my copy yet. I pre-ordered it. It's supposed to arrive literally any day. But it's called The New MAGA Deal by Peter Navarro. And if you want the playbook, like I said, I haven't read it because I haven't got it yet. I will soon, but I know enough about it to know that that's the playbook. So, but getting back to the first point, this is going to involve the end of the neoliberal consensus, the end of von Mises and Hayek, the end of the globalists, and tariffs all around and jobs in America.
Well, a lot of the points, I hope you're correct. Hamilton, in particular, was actually an individual who was very much in favor of tariffs to protect a nascent industrial base in the United States, and that actually would have worked wonders. It was interrupted very quickly by the election of Jefferson, effectively devaluing the United States industrial base to the point that the War of 1812 became a cakewalk for the British. It was the occupation, just like we saw with Iraq, that they ultimately decided they didn't want to deal with. Your various mixing across different components, I'm going to let go. But the really key thing is not actually the tariffs. It's what you're referring to in terms of the U.S. workers. And ultimately, I agree with you that the use of, quote unquote, free markets to justify the ability for China to export their demand deficit onto the rest of the world, the United States in particular, is something that'll change. It will prove to be inflationary. At the same time, it can drive tremendous investment in the United States. So I'm not actually anti-tariff. The point that I'm actually making on that is as Brent highlighted, that's far worse for the rest of the world than it is for the United States. We don't know whether it's good. It depends on how the rest of the world chooses to handle it. We have a very valid case to argue that the rest of the world has been dumping its surplus supply on the United States. And that has been negatively affecting all those who do not own the capital that produces and distributes it in the United States. I'm not pushing back against that. That's a very, very different statement. But the idea that it's going to negatively impact the collateral that many multinationals or many private individuals own in the rest of the world is significant.
Well, I agree with that conclusion, but that's their problem. I mean, I'm not defending big business, big capital, or certainly the neoliberals. I'm like, what about the American people? What about the American workers? You can make a good case that the decline of the British Empire, the roots of that can be traced to Adam Smith and the repeal of the Corn Laws. Like, once Britain had a massive mercantilist advantage, and the problem is, and Schumpeter said the same thing in 1950, the problem is you're a victim of your own success. You get very rich in a system, and you get so rich, you forgot how you got there. You forgot what it was that worked, and you think you can afford all these other things. And Michael, when you said, if we do this, maybe it's good in the United States, it's debatable, but I think it is. But the rest of the world could suffer. So what? I mean, that's their problem. Let them get, come up with their own solutions and their own policies instead of free riding on us.
Largely, I agree with you, Jim. I actually think it's really important to understand that most of my focus on this is in favor of the American worker, recognizing that there are going to be costs and difficulties associated with the adjustment period, right? But what is the uncertain portion is how the rest of the world responds. So when we allow ourselves to hollow out our production base to the extent that we have, where China supplies many critical intermediate goods, not necessarily finished goods, but intermediate goods, suddenly you can have very unintended consequences of the most benign and positive intentions.
But isn't that just a function of the imbalanced growth of the last half of the 20th century?
Oh, totally right.
Had it been done,
I'm not suggesting that we are not right. There's all sorts of issues, but the biggest issue that we face I would actually argue is the one that we all know is in the room, which is the general slowdown in aggregate population growth. It means that aggregate demand across the globe is slowed dramatically and is ultimately creating tremendously deflationary pressures.
Yeah, let me jump in here just for a second, because perhaps there are some people in the audience that aren't, they hear what we're saying, but maybe they're missing the middle steps. And one thing I would say is that you may have heard the term, the cure for low prices is low prices, and the cure for high prices is high prices, or maybe you've heard that deflation is the author of inflation and vice versa. I think a lot of times when we start talking about Trump's policies or tariffs or protectionism, however you want to describe what Trump and Vance have so far at least advocated, is that it will lead to higher prices in the US because the tariffs will be passed on to consumers. It will lead to supply shocks that will lead to higher prices. And that is all potentially possible. But what it also leads to is fewer dollars leaving the United States and going to the rest of the world. And the reason that that is important is because as of right now, the rest of the world largely still operates using dollars. This is the whole point of Jeff's channel. This is the Eurodollar, right? Jeff has pounded the table on this for years and has made the point that nobody is in control of the Eurodollar, and certainly not the Fed, right? And so if you now have a situation where the US has moved towards protectionism, again, whatever label you want to put on that, doesn't really matter to me. But if you get into a situation where fewer dollars are leaving the United States and going to the rest of the world, the only way they can get enough supply is if they risk their own balance sheet and extend credit in dollar terms to do so. And the problem is if they do not do that in a large enough amount, which I would argue they will not, because they will be under financial pressure that does not allow them to, then all of a sudden you get a contraction in the Eurodollar market. And that contraction in the Eurodollar market leads to a contraction in the US dollar market. And all of a sudden you go from an inflationary environment to a massively deflationary environment.
Brent,
Now, I don't know which one is going to happen. I'm just pointing out the dynamics that can lead when people say tariffs are automatically inflationary. Yes, but you need to think it through, right? It's not always the case, or temporary inflationary pressures can lead to massively deflationary outcomes.
Yeah, I mean, tariffs are like oil prices, right? Oil prices spike, and it sounds like it's inflationary, but eventually, give it a couple months, it destroys enough demand, and the opposite happens. I just want to ask you, Brent, and I know you've got. First of all, I want to ask you about Japan's yen and the Chinese yuan. Are we seeing in those the very nascent stages of exactly what you were talking about, where global economies under significant, especially trade pressure, and the ability of foreign actors to expand their balance sheet to offset that as best they can seems to be constrained. And one of the consequences of that is weaker currencies on the other side of the dollar. So I wanted to ask you about that. And I think that it kind of fits in with your milkshake idea. And, I wanted to bring that up too, because you have a milkshake workshop coming up, don't you? That you're going to go into more detail on the milkshake theory.
Yeah, thanks for bringing that up. We have not finalized a date yet. It's either going to be in August or September, but I'm going to do kind of like a full day deep dive into kind of my theory and the implications of it. Because a lot of times I'll come on shows like this, or I'll go to a conference and I'll speak for 20 or 30 minutes. But the reality is I could speak on 10 different parts of it for 10 or 20 minutes. So I'm going to try to do a deep dive. If anybody's interested in attending that, just send an email to masterclass@milkshakespod.com. Again, masterclass at
this isn't about ice cream and milk.
Yeah, I apologize for the shameless plug, but anybody that wants to kind of participate in that send an email there, and you'll be on the list for when it comes out. But going back to your point about the yen and the yuan, this is what I was getting at earlier, in that events outside the United States could lead to an event that causes the black swan and causes the contraction in the Eurodollar market. And so Japan, everybody I think knows at this point that the yen has just, for the most part, been in free fall, with the exception of the times where the Bank of Japan comes in and intervenes and supports the currency. But
for a couple of days.
Right. But the yen getting weaker is putting extreme pressure on China because it's a regional competitor and it's a global competitor. And as the yen gets cheaper, then Japanese goods are cheaper than Chinese goods. And China is dealing already with massive deflationary effects of their giant real estate market. Now, China's M2, I think, is around 45 trillion. And I think their economy is around 18 or 19 trillion. So their banking system is levered 3 times essentially to their economy. The U.S., as an example, is levered 1 time. We've got around, I think, $25 trillion economy, and we've got 45 or 50 trillion dollars of M2 as well. So their economy is much more levered than the United States economy. Their falling real estate prices are putting extreme pressure on their economy. They're doing everything they can to kind of stop that deflationary pressure. They just lowered interest rates. Was it yesterday or today? I can't even remember. As another effort to kind of contain that or combat that deflation. What could happen is if the yen continues to weaken, putting pressure on China, and if their real estate market continues to weaken, putting pressure on China, China may be forced to use the only release valve they have left, and that is the currency, right? And they may have to do a mini deval or a bigger deval of the yuan. If that happens, that sends a deflationary wave to the rest of the world. And when I say deflationary wave, I don't mean like a little tiny wave. I mean a hugely deflationary wave to the rest of the world. And that leads to this contraction or potential contraction in the Eurodollar market that we've talked about. That's the way a shock could happen, and kind of happen very quickly. Even though it's not a black swan, I think a lot of people have looked at this. A lot of people have talked about it. And it's not something I think China wants to do, but at some point they may be forced to do so. And
but Brent, surely the second order effect would be Europe, the United States, the West throwing up tariffs and barriers. They surely would not allow this to continue. Surely they would draw the line at that sort of demand theft.
Wasn't that where they already are? Because the Chinese have started to dip their toe into that type of strategy by running excess production and dumping it on foreign markets.
I'm bewildered. Maybe the politicians don't have our best interests.
You're bewildered by what, Emil?
I'm bewildered that the politicians don't have our best interests at heart. Yes, I'm naive. That they haven't already stepped in and put up tariffs to try to address the imbalance of China stealing demand by subsidizing their industry, exporting more than their economy can, and taking.
Well, I think.
But that's absolutely happening, Brent. Right? Yeah, I mean, you're seeing Mexico, the Philippines, you're seeing Malaysia, you're seeing the world around saying, "Wait a second, this is a problem." It's particularly perverse in the emerging markets. It's just the United States, to steal, from Jim Rickards here for a second. Let's quote John Maynard Keynes: "Practical men who fancy themselves exempt are slaves to a defunct economist." We worship at the altar of free trade of Milton Friedman, right? This is the guy who thought velocity of money was constant. If there was anything that was disproven in the last, 50 years, it's that velocity of money was not constant. And yet we still continue to cite him and rely on him for most of our policy decisions because it sounds so good. It's just
at heart, we're all doctrinaire. We all belong to a certain school, and we all fall into those types of thoughts. So I'm not going to blame Friedman for that.
Yeah,
I think we should touch on the fact that listen, the only speech I listened to at the Republican National Convention was J.D. Vance. I kind of had a fairly good idea of what Trump would talk about. I had no interest in listening to any of the others, but I kind of knew who J.D. Vance was, but I'd never really heard him speak more than asking like a question or two at a congressional testimony. I mean, if you think about the speech he gave, that is about as far from the traditional Republican economic policy speech as you can possibly imagine. For people who aren't versed in like traditional Republican versus Democrat, again, we don't need to get into what the differences are, but the point I'll make is the speech by J.D. Vance, I think, is in direct response to all the things that you are talking about, Emil. I don't see how you could separate those two. And, we've gotten to a point where the populist rhetoric, or again, however you want to define that, is at a level that the politicians can no longer ignore them. I think they ignored them for a long time. And then Trump came in and kind of got the ball rolling, saying, hey, wait a second. And he was very smart about the way he did. He's like, I don't blame Z. Z's very smart. If I was in his position, I would have done the same thing. So it was very clever the way he kind of put China on notice without personally attacking Z. But I think that started it, 7 or 8 years ago. And now, Biden largely continued Trump's policies, and, whoever's in next, I think, will ratchet them up to kind of counteract many of the things that you're talking about, Emil.
Well, look, this is the inevitable consequence of depressionary circumstances, because the depressionary circumstances, in the end, always the consequences always fall on the little guy. They always fall on the worker. I mean, John Maynard Keynes got that much right. He said depressions are all about the workforce and employment. And so it was a matter of time. We're talking about lack of black swans. This is sort of the inevitable consequence of a depressionary circumstance that just continues to go on and on. Eventually, some point, politicians would figure out that there's this groundswell of support for populist policies, because that's where the legitimate deficiencies of the economy actually are. The problem is we don't know, once some politicians tap into that vein, what they're going to do in response to it. That's kind of the argument that Jim and Mike were having. Okay, we understand that the American worker has been screwed. What the hell do we do about it? And there's various different ways to really think about that. And I think it's as Emil was saying, it's as much a political question as it is an economic one, because there is no easy answer here.
I'm pretty shameless about plugging my own books, but I'll plug J.D. Vance's book. Anyone, if you haven't read Hillbilly Elegy, pick it up and read it. It's not that long. And the reason is, first of all, it's a good writer. It's a memoir. It just takes you to a time and place and in depth, and where you're feeding infants with Mountain Dew instead of baby formula because you can't afford baby formula. I mean, that's real. That's in the book. But beyond the kind of sociological and the personal aspect of it, it really does get to the heart of the economic program that Trump and Vance are going to pursue. It describes the problem brilliantly, and then that understanding that problem leads to certain solutions, which are the ones that we've been talking about. And Michael and I were kind of, going back and forth on a little bit. So I would recommend great piece of literature, but I would recommend it as offering a lot of insight into what the economic policy is going to be over the next 4 years. And I just want to drop one quick footnote for Emil. When I started the banking business, started my career at Citi, yen was 400. So
it's going back there.
Yeah, everything old is new again. Yeah.
Hey Josh, you want to go? Let's go to another question, because we could talk. We could stick on this one forever.
Yeah, I think this next one's going to take a while too. What do you guys think is the most likely outcome for what will replace the Eurodollar?
Oh boy!
Besides, I'm sure you'll just say Bitcoin.
I was going to say, are we allowed to say Bitcoin?
What?
Is anybody going to venture a guess? Oh man.
Just to be clear, replace Eurodollar. We're talking about the offshore interbank deposits, not the euro.
Yeah, the Eurodollar system. Yeah, not the European common currency.
Yeah, I think you don't have to replace it. In fact, I don't think it will be replaced, but it doesn't mean that something can't come along side by side. I mean, the case study I use is the decline of sterling. Now, in June of 1914, sterling was the undisputed king of the hill, major reserve currency. Of course, they weren't a gold standard, but that's a separate issue. You can have a fiat currency standard. I think we've proved that. And by 1944, with Bretton Woods and pegging the dollar to gold, and all currencies weren't pegged to gold. They were pegged to the dollar, and the dollar was pegged to gold. That's how the Bretton Woods system worked. And the sterling was marginalized, and then crises in 64, 67, and finally it's a footnote. It's still there, but you really only need it if you're going to London. But that didn't happen overnight. That was a 30-year process, and Eichengreen did a brilliant job of scholarship. I disagree with some of his conclusions, but I'll give him 5 stars on the scholarship of showing the horse race between the dollar and sterling throughout the 1920s, and that messed up gold exchange standard that they had. But it wasn't like the dollar just ran away with it. It was like dollars, here comes sterling. You know, it was like really a neck and neck horse race until World War II was kind of the end of it. And then, and you know, of course, Harry Dexter White was a Stalinist agent, which Ben Steele has pointed out. And his mission from Stalin was to destroy the British Empire, and did a pretty good job. But the point is, it doesn't happen overnight. And there's plenty of room for more than one so-called reserve currency. The dollar is dominant. We all know that. It's about 58% of global reserves, and depending on the commodity, between 60 to 80% of global payments. Oil slightly higher, but that doesn't mean that there's not room for a new kid on the block. My view, and actually I was in a debate a couple of months ago with Brent. We went back and forth on this, but he's here, so he can respond in real time. I would not. A lot of people, this guy, I don't know him personally, but he calls himself Mike Shedlock, I think his name is. Anyway, they're mocking this BRICS currency. And I'm like, I'm sorry. If Sergei Lavrov is one of the big brains behind it, I'm not mocking it. I'm going to study it and see where it's going. It's not going to be here overnight. It's still some years away. The key to it is, Shedlock made the point that I can take, this piece of paper and call it Jim Rickards dollars and come and get them. And, and that's actually true. I don't know if anyone wants them, but you can create a currency pretty easily. You can create a payments currency. The key to a successful currency union and a fast growing payments currency is the number of members in the currency units, the number of countries. That's why what I focus on, not the technical details. I mean, I work with people who, create the euro between the Maastricht Treaty and in 1991 and the 92 and the rollout of the euro in 2000. That took almost 10 years. And again, the technical issue, which is really political, which is what was the convergence exchange rate going to be between francs and Deutschmarks and all the rest. So, but that's interesting. But setting up the payment channels, figuring out the relative values, coming up with backing, it's kind of a notional backing. I doubt it'll be a real gold standard where you can go down to the People's Bank of China and say, give me the gold. It won't be that. But the key is the number of members. And here's why. And like right now, Russia sells oil to India. India pays in rupees. You can set up a Russian bank account in an Indian bank, credit the account with rupees. You don't have to go through SWIFT. You don't have to go through any of these things they've been shut out of. The problem is, what's Russia going to do with the rupees? How much, chicken curry do you need? And there's a limit to that. So, and same thing with the yen for that, the yuan for that matter. You're going to get Chinese manufactured goods and some technology, but there's always a limit to that. So it's just kind of one step above barter when you have one trading partner with the currency. But the minute you open that up to 15, 20, 25 countries, and now Russia sells goods to any one of them and gets paid in a BRICS currency, and now you can go shopping. You got the currency from India, but you can buy technology from China. You can buy Embraer aircraft from Brazil. You can buy, well, they don't need oil, but other manufactured goods from Turkey, et cetera, depending who's in the club. And that was the key to the success of the euro. It was the membership. And there's no prohibition. Once you get to a certain critical mass, there's no prohibition on countries that are not formally BRICS accepting BRICS in payment. As long as they have confidence they can spend it somewhere, they'll do it. And so my point is, we don't really have to hypothesize the end of the dollar, like it dies overnight, or the end of a Eurodollar system. It'll be around, but there's no reason why a competing BRICS payment and then ultimately credit system can exist side by side.
It can absolutely exist side by side, but I also think that we have to be very careful in how we account for it. So the country of California exports a significant amount of goods to the country of Nevada. If we're talking about the euro or we're talking about currency unions, we have to acknowledge that the definition of state is far from static or consistent across regimes. right? So the idea that Germany exports or that the euro is used in these ways, we don't measure that in the United States in the same manner. The IMF doesn't track it in that manner, and yet it's equally as relevant to the point that you're making, Jim.
And I also want to drop a footnote on Brent's point about, I think Brent and kind of Michael made the point that if the U.S. does go with this high tariff, hey, you want to sell it here, make it here, invest in the U.S. By the way, this I've kind of identified the United States as a major investment target, because if I'm assuming Trump's going to win. If he doesn't, that's a whole jump ball. But I'm assuming Trump's going to win. But if they go with this policy, and I have very good reason to believe they will, the U.S. is going to be a really attractive investment destination because of lower energy costs and less regulation and protection. I mean, it's called protection. That's what it is, but it serves a purpose. I had India near the top of my list, but I would put the U.S. Right up there. But it does throw the burden on these other countries, and Brent was right about that. But that is the better solution to Triffin's dilemma, because what Triffin said is, if you're the global reserve currency, you have to run trade deficits so the rest of the world has enough of your money for them to buy your stuff or buy stuff from each other and keep the wheels lubricated and keep the economy going. And that was Brent's point. And that, but then Triffin went on to say, people forget the final statement. He said, but eventually you go broke. Like if you run trade deficits forever, so you're supplying the world with enough dollars to keep the economy going, and the banks are doing their jobs and everything's working, but do it long enough, eventually you'll go broke. But the other solution is, this is like, I forget the name of it. There's a Star Trek episode where, Captain, every Starship captain gets an impossible dilemma and none of them can figure it out. And Captain Kirk's solution was change the rules. And what you can do to get out of Triffin's dilemma is change the rules and say, no, America first.
Yeah, but that's what the Eurodollar did. The Eurodollar changed the rules entirely. It created a new international currency arrangement that broke the link between what Triffin was talking about and what actually happened. So
yeah.
My answer to this question is really, I think that we will see private competition in money as much as we'll see various forms of public versions of money, like a BRICS currency. I think there's more than enough intelligence and talent and resources in private digital projects that once they hit the right scale, there'll definitely be a viable solution across enough parts of the global economy. And geography doesn't actually matter to a private currency, nor does politics necessarily, that it becomes a viable solution. Again, I agree with you, Jim. The dollar doesn't go away, the Eurodollar doesn't go away, and it doesn't need to go away. But there's different places around the world that this is already happening, where people are transacting in USDCC on Tron, for example, all over the world. So it's just a matter of scaling, and it's just a matter of once it reaches a critical enough mass that it becomes more than just a niche case for a couple of people to send payments back and forth.
I think my contribution here would be, what comes next is really a function of two things: who a combination of who the global hegemon is and what people like Amancio Ortega or Paolo Lemon or Lakshmi Mittal, what people like that want to use. It does not matter what people like Modi want to use or Lula want to use or Sergei Lavrov, unless they're if they're the global hegemon, they will have a role. But if they don't, then it doesn't really matter what the politicians want to do. What matters is what the business people want to do, or what the politicians can force the business people to do. And so in order to come up with a new global currency, you have to be able to project power on a global basis. And I have a hard time seeing someone other than the US taking that role without massive conflict to do so.
Well, it's always the other way around, right, Brent? It's the commercial agents adopt whatever it is that benefits them the most, and then political power shifts to wherever the commercial system is. Exactly. What the Eurodollar did was basically demonstrate the power of a ledger money system across international boundaries. That was the secret to its success. So in some ways, the idea of going back to national currencies to serve as an international role, not only does it seem like a de-evolution, it's in many ways impractical in a globalized system. Now, yeah,
Well,
I
I
know
think-
the economy's kind of breaking up. It's fragmenting, but in many ways, commerce is global. Geography doesn't matter nearly as much as it used to.
Well, and this is, and I have to, Jeff, I have to give you credit because you are one of the very few people who by listening to you, I finally realized this. What made and makes the Eurodollar system so strong is the network effect of free market individuals choosing it for themselves rather than it being mandated top down. Most people think that it was mandated top down as a result of the Bretton Woods system, but that is not how the Eurodollar market.
No, it solved the problem of the Bretton Woods system.
It solved exactly. That's and this I wish there was some way to explain this in a very simplified manner to the world, because I think if they understood that, they would understand the system so much better. But it was the solution to the inefficiencies of the Bretton Woods system that led to the Eurodollar becoming so strong.
Yeah.
So.
Josh, you want another question?
Hey, Jeff, I
Yes.
told you I was going to be here for the full 2 hours, but I actually have to jump. I really apologize.
No,
But
that's all right.
thank you so much for inviting me.
We really appreciate it.
Thanks, Brent.
Mike, it was
Yeah.
good to see you. Emil, good to see
Good to see you.
you. Eric,
Remember, everybody,
nice to
check
see
out
you.
Brent's workshop. Check out the everything about that.
Jim, nice to see you as well. Oh my God, this is a good time to go. Bye-bye.
Mr. Van Meter is here.
Jeff,
Sorry, you have to mute you. It's a little loud here.
Jeff, let me use this time to
Go ahead, Eric.
to bring something up. Maybe I could reinvigorate the discussion between Mike and Jim.
Oh, you want to stir the pot?
I want to try and stir the pot a little bit. Jim mentioned something at the very beginning of this call, that the ramifications of high levels of debt is not a implosion of the dollar or necessarily even high inflation. It's sub-trend growth or reduced or reduction in the standard of living, essentially is what the ramification is. And that's something I agree wholeheartedly with. It's a focal point of the work that I do. And I think that the empirical evidence of that is overwhelming. I think Jeff, Emil, and even Mike, we've all come to the same conclusion, and we've all looked at the charts that have a trend line starting from, let's say, the 60s until 2006 or 7, and then we've been in this below trend state. So if we all agree that the sub-trend economic environment that we've been in that's fueled a lot of the populism in the country is primarily a result of increasing aggregate debt loads. And we can all agree that neither party is focused on solving that issue. In fact, both parties are almost certainly going to oversee the continued growth of that aggregate debt load. Then neither party has any chance of solving the below trend or substandard economic conditions that are fueling the populism. So whether we have tariff policy or no tariff policy, drill policy or no drill policy, these may affect things at the margin, but they're tantamount to a rounding error if neither person or neither party is going to address the larger issue. So shouldn't we really be discussing what are the ramifications of another 5 or 10 years of continued below trend growth, what the manifestation of that will be? Because whether we put tariffs or no tariffs, neither party is going to change that unless they address the actual problem that's causing it.
Yeah, it's like tantamount to rearranging the deck chairs on the Titanic, right? I mean, that's
exactly right. So I feel like to some extent we're, Trump will put on tariffs. Maybe, Biden, left on the original Trump tariffs, changed them around a little bit. Trump may knock tax rates from 39 to 35 and corporate from, whatever we're doing here. This is all very marginal moves. But both parties since, for quite several decades here have been overseeing larger and larger governments, as measured by spending as a percentage of GDP. And to the extent that that continues, we also are dealing with a nonlinear curve here in the sense that as the debt levels continue to rise, that sub-trend growth doesn't just stay sub-trend, it actually accelerates to the downside.
The gap gets bigger.
The gap gets bigger, exactly.
Yeah.
So whoever gets elected next, whether it's the Democratic Party or the Republican Party, either one of them is going to be dealing with a larger gap than the previous party did. That's going to fuel more populism than the previous party was dealing with. And the solutions that both parties are throwing out right now are not addressing that core issue. So, how do you guys think about that and what the impact of that would be?
But let me jump in first. I want to submit that that's the real job of the Federal Reserve. The Federal Reserve is not a monetary agency. It's not really a bank regulator either. It is an institution whose job is to allow the government to avoid these questions, because the Federal Reserve's job is for Jay Powell to get on TV and reassure the public that everything's just fine. And if things do go bad, what do politicians do? They immediately point the finger at them. It's like the old mafia boss that's not really running things, but he's the one who gets all the hits from the FBI stings and everything else. It's like Junior Soprano. I always think of the Federal Reserve as Junior Soprano. And so long as the Federal Reserve remains the lightning rod for criticism as well as the go-to authority, I mean, it can actually be both. It's not paradoxical. It's a lightning rod for criticism as well as the go-to authority on the economic situation. Neither party has an incentive to actually address the problem because they've insulated themselves from it. And therefore that allows them, as Eric, just as you're saying, to tap into the electoral dissatisfaction for their own purposes. To me, this is bipartisan failure up and down.
Yeah, Jeff, I should add that going back to the American system, or Alexander Hamilton, we talked about protectionism and tariffs and all that, and that is a big part of it. And that's
it's in a tight spot. You don't want
this is a crosstalk. That is a big part of it, and that's coming back soon. But the second, it was a three-part plan. The second part of the plan was a central bank. Now, they didn't have in mind the Federal Reserve, and I agree completely with your critique of the Federal Reserve. They're thinking of the first bank in the United States, the second bank in the United States, Stephen Girard, and Nicholas Biddle. And basically, that was around to buy government debt. And then once the government had the money from buying the government debt, the bankers were happy because they were making a spread between their cost of funds and the government debt, and the government got money, which was it was money, so that worked very well. But that was the financial tool to go with the protectionism and the development of industry and the mercantile expansion that they hoped for. So there is a role for a central bank, but it's got to be a good central bank, or a central bank with a purpose, not one that thinks it can run every aspect of the economy, let alone, changing the unemployment rate and all the rest. And just kind of flipping back to the Eurodollar and BRICS and all that a little bit, and to your point, Jeff, about cryptocurrencies, and I don't know them all. I know there are 2,000 at this point. I'm sure some are doing better than others, but there's I apologize
Very
for making
small number.
okay, I've dominated. By the way, there's very, very good research, and I don't have it in front of me, but I'm happy to share it. I can send you an email that from a couple of MIT, statisticians with really good monetary background that shows that over 90% of all the trading in Bitcoin are wash trades between whales.
Mm-hmm.
That there is no retail market. It's just, and it's a kind of a lot of speculation. But there's a new book. It's called Money and Promises by Paolo Zanoni. You may have read it, but I'll give you the one sentence version. It's like 8 case studies, Venice and the early American Republic and Britain and a number of important case studies. But his point is that every form of money in the last 900 years, except gold and silver, so put gold and silver to one side, every form of money is debt. We talk about M1, M2, we call it money, but it's on the liability side of the Federal Reserve balance sheet. Take a $20 bill out of your wallet, it says Federal Reserve note. Where I went to law school, note is debt, and indeed it is. It's a liability. Eurodollar deposits are liabilities. A CD is a liability. They're all forms of debt. And what banks really do is they take government debt and give you their own debt, which is a banknote, which is a note. And we call it money, but we kind of gloss over the fact that what really gives it value, and as some gold in a vault somewhere is probably good, even if you're not on a gold standard. We're not. I get it, but it's interesting that we do have 8,000 tons of gold. But so he makes a point that a sliver of gold and silver behind the whole thing helps to inspire confidence, even if you're not on a gold standard. But that the thing that really makes the world go round, but it's completely consistent with your Eurodollar research and writings, is that it's all debt. And that I see as one of the limitations on cryptocurrencies, because it's not debt.
Maybe, but I keep coming. I agree with you, Jim, about all of that stuff, especially gold standard inspiring confidence and the amount of fractional reserve lending and all of that. But at the end of the day, you keep coming back to the realization that the market system chose this form of money. Yes, all of this money might be debt, but the commercial system is comfortable with that idea. In fact, more than comfortable, continues to choose that form of debt over and over and over and over again. So rather than fight against that, what seems to be a natural instinct to have money that's mobile and flexible and dynamic, figure out ways to improve upon it.
No, I'm not fighting against it at all. In fact, I agree with your conclusion. That's exactly my point, that the market likes debt. As long as you have some no, seriously, as long as you have, and I don't mean as a borrower, I mean as a holder. As long as you have some confidence in the debtor, you're happy to get the debt. You quite frequently would rather have bank debt or Eurodollar debt or some other kind. I'm using the word debt. It's an asset to me. It's a debt. It's a liability to the issuer, but it's debt. That's just a not polite way of saying credit. But not only does the market comfortable with it, they prefer it, and governments prefer it. They're like, please take my, continental, Congress debts, whatever they may be. I mean, Alexander Hamilton was the one who said, because the Congress, when they were writing the Constitution, said, what do we do with all this Revolutionary War debt? They said, well, we're Americans, so let's just default. Like, let's not pay it. We can start with a clean. And Hamilton said, no, let's borrow.
The tradition for a long time. People don't realize that. That was what we did. We defaulted.
Yeah, it was. And Hamilton was the one who said, no, let's borrow more, pay it off, and then borrow more after that, and we'll pay off the new debt and keep going. And he was right. It's called a Ponzi, but it's been going strong for 235 years. But it's all debt.
Yeah, but that's outweigh the cost.
Jeff, give me 1 second here, because unfortunately that's not entirely true, right? What Hamilton actually argued for was the assumption of state debts in exchange for them forfeiting their rights on Western lands. So the federal government suddenly found itself fantastically asset rich at the same time that it created a marketable security that could be used to underpin the U.S. currency and U.S. trading relationships. That's a very, very different story. It exchanged one asset for another, and ultimately that second asset turned out to be a fantastic investment relative to what we thought it was at the time, right? So it's disingenuous to think of it as we just added on debt. And that is actually the core of the issue right now, which is when you talk about debt slowing growth, actually debt can hyperinflate growth if you spend the money well.
Well, that's
if you make the right investments.
That's what banks are supposed to do, is be able
Correct.
to intermediate.
And that's exactly the point of banks, is it's the private sector interjecting the credit component where it says, I think this is a good investment, that allows that horizontal as compared to vertical money creation, to use the terms of MMT, to add such incredible value. We've completely abrogated that. That's really the core of the situation.
Exactly the same. It's a very similar.
100%,
Eurodollar created balance sheet capacity that was used to basically buy the entire freaking world. It was a fantastic payoff for those who actually put the resources into it. The problem is,
absolutely correct,
it happened to be a cartel of global bankers that kind of got lazy and just kind of let it all go to hell. To get back to Eric's point about, what do we, the ultimate issue here that we're really debating is how to get everything back on track so that it works for, more people than just those who are heavily involved in finance, because that's basically the only way to get rich these days. And I want to thank and point out to Steve Van Meter, who's here from, it looks like you're at the water park in Disney, and George down in Columbia. You got George Gammon and Steve Van Meter here. You guys have any thoughts you want to share too?
Yeah, I wish I was there with Steve. Looks like he's having fun. It looks like Jeff Spicoli of economics. I remember we said, all I need is a cool wave and a toasty buzz. That's Van Meter right now.
Hey, Jeff, before Steve,
I wish you all were here.
Yeah, before George and Steve jump in, I've got to sign off. So, but first of all, thanks for the invitation.
Thank you very much, Jim. We really appreciate it.
Great, thank you. Bye-bye.
Thank you, Jim.
All right, now we're down to
Jeff,
6
that
again.
kind of goes back to the next question. That was, what metrics would you guys look at to see if the economy and monetary system are starting to head in the right direction?
Okay.
Can I jump in here and actually share a screen?
Yeah, absolutely.
All right, fantastic. Let me see if I can get this up here properly. All right, it's telling me I've got too many screens. Okay, this is the chart that I think is actually really, really important. So this is comparing U.S. GDP per capita versus U.S. GDP per worker. And remember what GDP actually is. GDP is gross domestic product, and so it can only be produced through the production function. If we import something, it subtracts from it. If we export something, it adds to it. Now, whether that's right or wrong is completely debatable, and I'm not going to worry about it too much. But a lot of what we're experiencing, and this speaks to the point that we've been in a recession since 2008. I actually think we've been in a recession or a depression really since 2000 period, is it's a function of demographics primarily, right? So this is looking at the relationship between GDP per capita and GDP per worker, which was largely flat from the period of 1950 to 1975. Then the baby boomers, really 1971, the baby boomers come of age, right? And suddenly we have more workers per capita. We get women in the workforce, we get minorities in the workforce, we get all sorts of people contributing to the taxable base of the economy. And everything feels great after the initial inflationary impulse of needing to absorb this dramatic increase in workers. Look what's been happening ever since. We've been adding to the non-productive aspects of our economy while limiting the impact in terms of, or limiting the growth of the productive aspects of our economy. This is really straightforward, right? If you tax effectively the workers more and more to pay for the unproductive, and I hate to use that term for old people, but that's what they are. If you tax the workers for the unproductive members of society in order to deliver on promises that you made when you thought you were on this trajectory, you're going to get really bad outcomes. And that's what we're experiencing.
I'd just like to point out that Joe Biden is very productive, Mike. So
Oh, it's super productive.
How dare you?
Exactly. He's all over it, man.
So, Mike, there's no hope then?
No, there's
for-
absolutely
Is there an
hope.
economic, is there a
There's
demographic boom
absolutely
coming
economic
from
hope.
millennials or no?
So there's a couple of things that we would need to consider to be quite important in that, right? One is that would encourage you to actually invest in productivity in terms of actual production technology, right? That we have failed to do. One of the other things that you can do to dramatically increase production per capita is to make available cheap and efficient energy. We've totally failed on that front. We're off pursuing all sorts of ridiculous, hey, let's get energy from wind as compared to splitting the atom, which we discovered how to do 100 years ago or 80 years ago, right? 90 years ago.
But Mike, sorry to cut you off. Doesn't the private sector need to decide that that's a good investment in order for it to be maximally efficient?
It can't decide that if the public sector effectively says no way. It's like the Catholic Church threatening to burn Galileo at the stake for telling you that the planets revolve around the sun instead of the reverse.
So you're saying more along the lines of deregulation versus the government actually allocating the credit?
Actually, I would argue in favor of regulation as compared to deregulation, because what we have right now is a largely kleptocratic system that is designed to favor the incumbents. We would far prefer to see them acquire their way to quote unquote efficiency as compared to face the slings and arrows of an actually competitive marketplace.
Mike, you got to define your term. When you say regulation, what you're really talking about is authorities who don't necessarily, like Eric's saying, get involved into credit allocation. Regulation is designed to ensure competition, transparency, that type of thing.
I think this is exactly why you heard me refer to it earlier, that we are slaves to the defunct economist Milton Friedman. We embrace free markets without understanding that free markets themselves are an aberration. They exist because we maintain the aquarium in which they exist. Right? If you leave an aquarium by itself and you don't actually clean it, or you don't actually enforce the dynamics of, gosh, I forgot and I put a piranha in with goldfish. Guess what? That's not a free exchange of ideas. Right? That's a free exchange of intestines.
One way I look at that, Mike, is, I don't know if you know this, but I was recently in Argentina, and I was going across Argentina trying to make my way over to Doug Casey using nothing but Bitcoin, gold, and silver, which was pretty challenging. But when I'd never been to Argentina, and I was expecting to see Venezuela. Mm-hmm. From a standpoint of some severe poverty and dysfunction in the economy. I was expecting to see tent cities. I was expecting to see people like just, trying to steal for food. I was
so you thought you were going
to
see Oakland, California. Got it.
Yeah, exactly. But I thought I'd see barren shelves in the grocery stores. Pretty much all the things that my employees tell me about Venezuela, because I've got a lot of employees here in Medellin. I think some you met at Rebel Capital Labs that actually fled the hyperinflation in Venezuela. That's what I was expecting. I got the opposite of that. Now, I'm not saying that their economy is running on all 8 cylinders. It's obviously suboptimal to have hyperinflation. But you compare 2 hyperinflations where you would assume the outcome would be identical, and the outcome is night and day difference, night and day. So the only conclusion that I can come to is it's got to be something else. It's got to be some other variable, and it's got to be the government, the overreach of the government in Argentina wasn't to the degree to which it hampered entrepreneurs. It might have decreased their output, but it didn't restrict them to the point where they couldn't do anything. Where Venezuela, it did. So even if, I think, going back to your point, even if you've got all the energy in the whole world, you've still got to have the right policies. I would argue those policies would be, smaller government, kind of getting the government out of the way. But even if you want to argue that you've got to have better regulation, at the end of the day, that matters just as much as having the resources to begin with. And then, as you point out, energy is the economy. And therefore, energy is the standard of living. But only if you have the right regulations to where the entrepreneurs can go out there and produce.
Yeah, and the point I would make around Argentina, and I think your statements are actually quite profound, right? It's one of the reasons I object so strongly to the idea of fix the money, fix the world, right? Which is
Same
it's
here.
a terrible play on the I think it's the 2000s TV show Heroes, right? Save the cheerleaders, save the world. If we just have the right money, everything will be fixed, right? That's simply untrue. Right, you can have a gold-based currency and dysfunctional fiscal and trade policy and property rights, and you're going to get terrible, terrible outcomes. And the reality of the world that we inhabit right now is that the Congress and those who are tasked with setting real policy have abrogated it to the Federal Reserve. Hey, fix this problem for us, Jerome. Right, that's really where we are. We're terrified of making any choices that actually say, no, we're going to pick X over Y. Right? We just don't do it. We're terrified of it. And it's because we're completely uneducated in economics. We're completely uneducated in what capitalism actually means. We're completely uneducated in what free markets mean. And a lot of the conversation around monetarism is tied to it.
Yeah. It kind of goes back to what you guys were talking about with the Rickards, where I think, Mike, you and I have discussed this, but most people don't realize that the M2 money supply in the United States grew at the exact same rate from 1870 to 1900 as it has from 2000 to like 2020, even when you consider QE1 to all the government deficit spending. M2 money supply went up at pretty much the exact same rate. So that tells you that regardless of what type of money you have, if you think it's going to fix the world, at the end of the day, the banks are going to do what the banks are going to do, and that they're going to control the quote unquote money supply.
Yeah, that's what we need to fix, though. That's the part where we fix the money. If the banking system isn't going to perform the job that it's supposed to, then it needs to be It needs to be reformed at the very least, if not eliminated.
But why would they perform the job that they're supposed to when we've guaranteed them free profits?
That's exactly
Okay, so
what I'm saying.
that's exactly
The
where I was
incentive
going with
structure
this.
is not aligned to where it needs to be.
That's where I was going with it.
Let's say, what incentive do the banks have to lend? I mean, just buy freaking government treasuries. Like, there's no incentive.
100% agree with you, Steve. Like that really is the core of the issue. We decided that the objective was to manage inflation by limiting the circulation of dollars as compared to actually focusing on the credit cycle, right? And the credit allocation process.
But it goes back to what you said, Mike. It's all about economic illiteracy.
Unfortunately, I think that's right.
Yeah.
Yeah, but I see that through the lens of bailouts. You know,
I agree with you, George, but that actually is so this is one of the issues when it comes to a flexible currency, right? Remember what a flexible currency's real objective is. It's the objective of a flexible currency is to be able to say, okay, we as a society screwed up, let's do a mulligan. Right? That's really what it is, right? It's the exact same thing as dischargeability of debts through ban. I made a forecast as to my income. I was wrong. let me start over, because at the end of the day, I'm a pretty good guy and I can contribute to our society. Right? That's what a flexible currency is meant to provide. But if you abuse it, then nobody actually trusts your ability to pay any form of debt. And secondly, if you abuse it, you destroy all of the incentives to actually generate a meaningful return on those investments.
Yeah, but so if the banks were in control of the money and they were incentivized by only lending for productivity because they had to keep those assets on their balance sheet, and if they didn't do a good job of lending to the right people that could pay them back because they produced more goods and services, then they go bust. And so you have that incentive structure where if you come in and create that moral hazard, then to your point, why not just lend to anybody with a pulse? And then, we'll just see what happens, because we know that the government's going to come in and save the day, or the Fed. And we're never going to get a perfect system. We all have to agree on that. It's never going to be perfect. It's just the least bad system that we can set up.
Remember the person who's actually doing the lending, right? It's not Jamie Dimon, who's a billionaire, who's like, oh, you should really lend to this guy, right? It's some senior loan officer somewhere in the middle of nowhere who's basically saying, oh, okay, we should lend to this guy. Why? Because if things blow up, he knows, and that one, he's not going to be held personally responsible. And two, there's a reasonable chance that that guy hires him in the future. It's no different than the regulatory capture associated with the US government, right? So you have a system in which the entire incentive of the system is truly, truly perverse. I see people putting gold is real money, right? Everything else is just credit. That's a perversion of the quote from JP Morgan, in which he was correctly identifying that the role of gold was to cancel debt. The role of money is to cancel debt. If I show up with money, I get to cancel my debt. Everything else is credit. Everything else is credit. That is absolutely true. So, we've encountered this scenario in which there's just this deep misunderstanding of what we're trying to accomplish, the real value that we're actually trying to create. And it's created this system of perverse, effectively corrupt incentives, where the best thing I can possibly do as a senior loan officer is lend to the local, auto dealer, because there's a reasonable chance that he's going to hire me as his credit manager for a multiple of what I'm being paid by Washington Mutual.
So how do you point that in the other direction without creating a scenario that's worse due to unintended consequences? Because we know that there's a cost benefit with everything. So if you change something by creating a different incentive structure, that may have a benefit, but it's always going to have a cost. So the question is, do the benefits outweigh the costs? So what would be your strategy? And then where would you see the potential, or why would the benefits outweigh the costs?
I'm not sure where the feedback is coming in, but
is that me?
I think
it's Van Meter.
I think it's no. Oh, yeah, it's Van Meter.
Yeah, it's
right.
Yeah. Steve, you've got an
STD. It's a sound transmitted disease. Unfortunately, the answer to this question of how do you actually create an incentive system that responds to it is that you do have to have elements of consequence, and we don't have them. right? Either in the political sphere, we're not taking responsibility for our actions. I would love it if we did. I would genuinely love it if the American public held people responsible for the decisions that they make as elected politicians. If we held Congress responsible, but we simply complain about them. We just don't want to actually do any work. And the reason why is because, man, Chipotle burritos taste so good. Right? Who
Mike,
really
we
wants
tried
to
to hold
complain
them
about a system?
responsible, and then we got in trouble. We got arrested. We tried to storm Congress, and then all of a sudden it's against the law to burn it down.
But isn't the ultimate
Just trying to-
consequence just loss? Isn't the ultimate consequence loss on a P&L?
No, right? Because remember that loss on a P&L is an abstraction of the actual loss, right? So there's two separate types of loss. There's loss against potential, which we've experienced broadly since the 1970s because we've pursued all sorts of terrible policies.
Right,
and there's
right.
loss against what you have right now. And it's that second loss that a portion of the United States is beginning to meaningfully experience that's driving the populism and frustration with the system. And it's when that loss starts to hit the elites. And when it hits the elites, then you're going to hear the outcry.
Yeah.
And competition among elites is where we all discover we're ants getting stomped under the toes of elephants.
I don't think that's necessarily the consequence of a dynamic, flexible currency system, because inherent in any flexible system is the idea of loss and discipline. It's part and parcel with the whole thing. But it's not a perfect design, and if left to its own devices, it should be to some degree self-regulating. That's, I think, where the dynamic Eurodollar system really went off, is that it did not self-regulate for a variety of reasons, most of which are just flaws in humanity. Not necessarily the system itself, nor in the mathematics that were created arrogantly thinking that they could define it. It was essentially just like any other credit bubble. It had its inherent flaws, and inevitably it all blew apart. The question isn't that. The question is whether or not the trade-off was worth it. And that's the question we inherently struggle with from the very beginning. What is the best system that we could possibly come up with that maximizes the upside versus the inevitable downside consequences as they emerge?
How do we know that wasn't? How do we know that wasn't it? Maybe that was it, Jeff.
Maybe what was
maybe
it?
The Eurodollar system. Maybe that is as good as we can do.
That's what I'm saying. I don't think that necessarily is the case, but I think there's a case to be made that it can be improved upon. That we take a look at the best parts of it. That let's face it. I mean, if we take a holistic approach to the system over the last half century of the 20th century, the United States came out in certain places on the short end of it. And believe me, I grew up in the Rust Belt, so I know what I'm talking about here. But overall, if we think beyond national boundaries, we experienced a period of unparalleled prosperity and peace throughout the world that we've never seen before. I'm not saying that was all about the Eurodollar system, but you can't deny that that was at least part of it, and that there's at least a correlation to investigate. So if that's the measure of the upside, why would we not want to do something like that and replicate its results?
But again, Jeff, like, what does the Eurodollar actually represent to you? To me, the Eurodollar is just a tool to facilitate credit allocation by the private sector.
Yeah, but it's an exceptionally important tool.
Oh, I'm not disagreeing with that. I mean, it is remarkable in both its flexibility, which is the point that I was making before, and in its universal capability to raise human capacity around the world. But this is one of the great ironies. We're slaves to things like GDP, right? When Kuznets was actually developing the system of national accounting, he actually wanted to include things like household labor, right? The reason it was excluded was because it was non-taxable. You're going to tax a housewife for cooking dinner, right? So, like, the system becomes, this is the point that Jim was actually raising with the Posywid reference, the proof of a system is what it does. The proof of a system was designed to raise taxes. And then bizarrely, we introduced under Reagan a system in which we decided, hey, let's minimize taxes under a system that's designed to maximize taxes. Guess what? You get extraordinary dysfunction in that system.
Yeah, but
Mike, we were coming out of
Go ahead, Emil.
Mike, we were just coming out of the period where the pendulum had swung too far in that direction. It had been overwrought, and It was simply a natural outgrowth that we would head the other direction, which we have been for 2 generations. It's gone too far, and now we're heading back towards where we were during and after the Second World War. I would think the government's going to get more involved.
I 100% agree with you. And I think that is actually possibly one of the best places to summarize the entire experience that we've gone through. If you listen to the billionaire lobby under Trump, it said if we just deregulate further, everything will be made perfect, right? And the simple reality is, as much as I would love to pay lower taxes, as much as I would love to have less intrusion of the government in our lives, and by government, at this point, we're fortunate enough to mean government of the people, by the people, for the people. There is no guarantee that we come out the other side of this with that system, right? You've seen the data that's come from the Pew Center that says only 20% of Americans think that the US democracy is a reasonable system to promote to the rest of the world. Right? We don't believe it ourselves. I see it in the comments, right? My vote doesn't count. Our votes don't count. Right? The simple reality is your voice doesn't matter to Google. They couldn't give a damn, right? Turn on your private browser. They're going to continue to monitor you, right? The reality of the regulatory environment is one in which those who otherwise would not face consequences are forced to prevent you with elements of truth, right? That's what a regulatory environment really is about. Now, it can be perversed, and it can be corrupted, and it can be turned into a system like they had in India for years and years and years, in which basically it becomes a system of enrichment of bureaucracy. And that's where we're headed, right? Rome is a city built to be bought and sold, right? But we're not there yet. And so if we wake up and we actually ask for something truly different, and we don't pretend that the answer is embedded in a narcissist or in a, narcissist in both directions, candidly, right? I mean, if we actually move in that direction, maybe there's hope. But it's about educating our children, educating ourselves, teaching ourselves what really matters, focusing ourselves on respecting and raising others' ability and human capital around the world. The US population is the most unique population in the world. It is a group of people who said to the rest of the world, fuck you, I'm going somewhere where I make my life better, right? That's an extraordinary resource, and we've completely ignored it.
Mike, when you talk about flexibility, are you talking about elasticity? You're talking about money elasticity?
Money elasticity only matters to the extent that's actually used properly, right? So if I use money elasticity to forgive the mistakes that my friends made to ensure that they can continue to come to the dinner parties that I host, that's not a good use of the system. But if I recognize that occasionally we decide to buy into views, or we occasionally decide to pursue opportunities that don't work out, right? Let's talk candidly about things like, solar energy, et cetera, right? Should we all be held hostage to those dynamics? No, we shouldn't, right? But
when you're talking about flexibility, you're flexibility in the money supply or money system, monetary system. You're talking about the elasticity, so the money supply can grow and contract.
That is a feature, right? So just be very clear. That is a feature of 2 separate components. One is the horizontal money, right? The money that is created by the private sector has that ability to expand and contract. I will extend credit because I think that there's good investment opportunities. I will withdraw credit because I'm concerned about the investment opportunities. The government's ability to increase or decrease the money supply is simply a function of print and tax. Right? That's a very blunt instrument. We see it in the actions of the Federal Reserve, in which they're hiking interest rates in a manner that is completely inappropriate for large segments of the US population, large segments of our economy. This has been pointed out now by the Minneapolis Fed. It's been pointed out by the Bank of International Settlements, et cetera. And yet we hero worship at this idea of Milton Friedman and Paul Volcker, and candidly go back and read the actual Fed meetings from the 1970s and 1980s and the nonsense that was absolutely discussed. And Paul Volcker ultimately won by throwing in the towel and saying, this is nuts, I'm not pursuing this.
Right, but what do you mean specifically when you talk about flexibility of the flexible monetary
That's
system?
actually exactly the point that I'm making, George. It's not just about the monetary system. It's also about the priorities we set as a society.
Okay, I just wanted to clarify, because the people that follow Jeff are going to at least might assume that that's the same thing when Jeff talks about the elasticity of the money supply. So I just wanted to clarify.
Well, don't forget
Yeah.
too that elasticity is a two-way street. It's not just strictly about when things go bad and we bail out banks. Elasticity is the ability to expand monetary and credit conditions when conditions call for them. And that's again the multi-trillion-dollar question. It's one that we've been struggling with ever since there's been money. What makes a good idea what different from a bad idea, and who gets to decide that? That's really what we're talking about here. How do we maximize the potential of an economic and financial and everything and complex system? What is the combination of factors that will lead to the best possible outcomes? And the truth is, as Mike is arguing and as Jim are arguing, is that it's not as simple as one thing or another. It's almost magic in that everything has to combine in just the right way at just the right time. It's something that we can't design ahead of time. It's almost just like pure luck that everything just kind of falls in the right place.
That's
Jeff,
free market capitalism.
Exactly. It's a bottom up.
That's exactly right.
It's the marketplace of ideas where the right solution emerges and then gets adopted in widespread fashion, not because somebody said so, but because everybody decides, or at least enough people decide, this is the way that works for the most of us. It's not quite game theory, but it's in a similar type of a discussion.
It absolutely is in a similar theory. Like most of your audience is going to be far too young to remember this. George will remember it. Jeff, you'll remember it. Emil, I think you might be actually be a little bit too young, and that's not an insult.
What are you implying, Mike?
He looks too young.
I'm almost 60.
Eric, you're way too young, man.
Right, Eric is definitely too young.
Way too young.
Do you remember our choice of phone that we would receive in 1980? Right, I remember the excitement around there being touch tone phones versus rotary dial phones. Oh my gosh, that was the most exciting thing. And then AT&T opened up retail stores and you could buy a Mickey Mouse phone or a duck phone, right? Now, people bought all sorts of ridiculous phones and all sorts of silly things happened. Were those profitable investments? Were those great, decisions to make? No, but you know what? You were freed from the oppression of a monopolist system that had been decreed for give or take 60 years. Right? We freed it through competition. We introduced all sorts of interesting stuff, and we set loose a revolution in telecommunications and telecommunications costs that changed the world from one of, hey, you can talk to grandma for 30 seconds because it's $7 a minute to call Oklahoma, which is the experience that I had, right? This is a big, huge cost, right? All of a sudden it became effectively free through the power of private enterprise. And now people turn around, they're like, oh my gosh, if we deregulate, if we were to split up Google, if we were to do X, Y, Z, you're going to have this terrible outcome. What the hell are these people smoking?
Well, the question is, the AT&T deregulation, demonopolization, would that have happened without the government stepping in? Because I would argue that it was only a matter of time that AT&T was on its last legs to begin with.
So I agree with elements of that. Right, I absolutely agree with elements of that. But if the system actually relied on AT&T being able to hire a group of Pinkerton detectives who would break the kneecaps of anyone who tried to enter their market, then the answer is, of course, we would still be buying rotary phones.
See, I don't agree with that part. I think that commercial enterprises and commercial pressures far outweigh the ability to restrain them through brute use of force.
And as an entrepreneur, I never ran a huge company, but the biggest company I ran had about 100 employees, and I knew that I had to compete a lot of times with much bigger companies, and they had several advantages, massive advantages, and that's the ones that you typically hear. Oh, they'll just buy you up. Oh, they could just put you out of business. Blah blah blah. But what people don't realize is if you're a business with 10 employees. You've got a lot of advantages. You've got some, there's a lot of pros, let's say, if you got one of 50, 100. So you're very nimble. So that's where I always came in. I'm like, we would most likely see those monopolies deteriorate over time because the bigger a corporation gets, it's like the government. It gets to a point where it's very inefficient. And although it does have massive resources, it still doesn't have the nimbleness of that small company that can out-navigate it, out-compete, and then take their business, and then you just go through that Jupiter's creative destruction.
You're talking about creative elasticity.
So
Yeah.
I gotta run, guys. Thanks for having me, Jeff. Good seeing everybody.
Thanks, Eric. I really
Bye-bye.
appreciate it, man.
Sorry, we didn't give you more airtime. George, I got to tell you, man, I totally embrace your point in principle, and yet would point out to you that if you were standing up the Sheriff of Nottingham in King John's England, you would have been dead.
Right, but
dead is a state that is really hard to compete from.
Yeah, but I'm talking.
We're not quite at that type of argument, though.
Yeah.
A
more free market system with the government having to get in and break up the monopoly.
100%. But this is actually exactly the point, right? You don't want a completely unfettered system, and you don't want a system that is completely controlled.
We don't necessarily want. Look, regulation, in my view, should be about what we're just talking about, competition. But do we necessarily want the government to decide what's competitive and what's not competitive? Because we already have an FTC that does nothing about it anyway.
That's exactly the point. The FTC does nothing about it.
Right.
Right. We have established rules. We know anti-competitive behavior. We actually know what it is. We changed the interpretation of those rules in the 1980s. We are now dealing with the consequences of that change in interpretation, and we need to reverse elements of it. Is Google anti-competitive? Is anyone on this? Certainly. Okay, so we've got 3 people left. George, do you think Google is anti-competitive?
Do I think they're anti-competitive? Oh, as far as they're pursuing their interest, is their interest Absolutely, yeah.
Okay, Emil?
But so was TWA in the 1970s.
100%. What happened with TWA?
The free market took it apart.
They deregulated their lines, and no, that's not what happened to TWA in the 1970s. That happened to TWA in the 1980s.
Okay, well, Mike, let's be clear. You're a lot older than I am.
Yeah,
so I was very young at this time.
I get it.
So educate us youngins on the call right now.
But that's exactly so what happened in the 1970s is the deregulation of the airlines that broke up the monopoly that Trans World Airlines actually had on both gates and plane contracts. Right? So we created competition, and then the dinosaur died. And they were reborn for a period of time through various levered instruments, right? And then ultimately they truly went away. Now we have a system that is, again, anti-competitive. The 4 of us all agree that the world's largest, search engine is distinctly anti-competitive. It's now actually sitting with a judge in Santa Clara to decide whether that requires the breakup of the company. This is very straightforward. We know the answer to this. They have engaged in anti-competitive behavior. The company whose motto was "Don't be evil" has been as anti-competitive as they possibly could, making over 1,500 acquisitions in the last 10 years and in a variety of ways to stifle competition in the online advertising market.
But Mike, we're talking about inelasticity among regulators. Once they became co-opted and changed their mission, there's no way to change it back. So what the hell good is the regulation? You see what I'm saying?
You're describing. Listen. You're preaching to the choir here, right?
No, I know, but
I am not flipping it around and saying, gosh, the answer is big government, right? The answer is effective government.
Yeah, but that's I can't make that. How do you get the government to become effective?
And if it's effective today, what's the probability that it's going to be ineffective by giving it that power within 10, 15 years? Then it goes back to the cost benefit.
That actually is exactly the cycle that Emil is referring to.
Yep.
Right. So it goes. Right.
Hey, Josh, let's get another question in before we keep going too far.
Before we kill everyone, yeah.
I assumed you guys had answered all by the time I got on.
No, I think we've taken like 4.
Is Josh in there?
He's coming.
Yeah.
Yeah.
So the next question is, can you guys explain what it would look like if tomorrow the Federal Reserve ceased to exist? Like the beautiful hat George and I are wearing.
You mean people would have to think for themselves for once? I think that would be Armageddon.
Yeah, I think it depends on if it's tomorrow or if it's just gradually over 5 years, and it's not a surprise to the market. I think those are 2 different outcomes.
I honestly think it wouldn't change a whole lot. I think there would be some messiness in the initial stage, but eventually we would normalize to a system that would look pretty much like it does now. So the absence of the Federal Reserve would be it would be highly negative to the financial media because they are invested so much in that narrative and that idea, but it actually would be positive in the long run for the various reasons that Mike is laying out here. Without the Federal Reserve to rely on, people might actually have to start thinking for themselves and thinking through some of these issues and coming to maybe rational conclusions rather than farming it off on Jay Powell and saying, well, I don't want to think about this because it's too difficult. So I'll let the Federal Reserve dictate what I think about all of these economic and financial factors. Because the fact of the matter is the Federal Reserve doesn't really supply anything interesting or useful other than a narrative that allows the political system to maintain an arm's length from all of these issues.
And if we all agree free markets are the best direction, why not a free market in interest rates?
So I come somewhere in between the two, right? So you guys have all seen the movie Home Alone, right? Kevin McAllister wakes up, suddenly his parents aren't there, and hilarity ensues in a variety of ways, right? Kevin McAllister is really smart. He's able to defend his home from, the invaders who are going to come and take possession of his parents' belongings. It's a very wonderful story, right? Simple reality is in the real world, Kevin McAllister probably ends up getting raped and sold off into white slavery, right? And, terrible, yeah, exactly, right? But terrible things end up happening in that scenario. The house burns down, blah, 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 right?
Well, that's why traditional fairy tales were always so dark and horrific, because reality is exactly like you're describing.
I wish it wasn't. I really, truly wish it wasn't. So there's a reason that we created the Federal Reserve, because we recognized in the absence of the person of JP Morgan, right, the famous, gold is money, everything else is credit, that we ran a very real risk of there being no adults in the home when the robbers showed up, right? So choices have to be made. The problem is that we've disassociated our society from either the ramifications or the understanding of those choices. We've created a giant fantasy, right? So are we going to solve that? Well, the solution to that takes a long time. We have to, educate an insane number of people and position them to be capable of voting for their own interests in a mature and adult way. And we're just so far removed from that as a society right now that I'm not sure we're going to get it back.
That's why I advocate deregulation of the regulators. Rip the Band-Aid off, throw everybody in the deep end of the pool, and let the free market sort out the good ideas from the bad ideas. It works in all venues. Get rid of the Federal Reserve so you don't have that crutch. People have to learn because they don't have a choice. Yeah, could it be messy in the short run, but yeah, I think the long run is worth it.
In the long run, we're all dead, Jeff. Right?
You're thinking way too far.
Jeff,
no, I'm not. That's actually the point.
Jeff, do you think if we didn't have the Fed, we'd ever get an inverted curve?
Yeah, I think they would still happen because, nothing is perfect. Not even the bond market. The bond market makes tons of mistakes all the time. So it's, the idea that we can have an ideal system. I mean, we all agree on this. So there's no such thing as an ideal system. There's no such thing as a perfect solution. What we're simply trying to argue, which is a very complex topic, is what is the best set of factors that we could possibly combine such that it maximizes the chances for something that appears to be an optimal outcome, but it's never really optimum. It's just good enough that it keeps everything moving in a general direction that we all associate with progress and advancements and rising living standards and everything else. And it's also recognizing, part of that is also recognizing all of the ways in which the ingredients are not fitting together and which things are standing in the way, impeding that progress. And I think I agree with Mike 1,000% that illiteracy is right up at the top of that list. But my argument is the reason illiteracy is at the top of that list, and believe me, my entire career has been about this, is the fact that everybody got lazy with the idea that the Federal Reserve somehow engineered the Great Moderation, let's be clear here. The only reason we care about the Federal Reserve, because you go back a generation before that, as Mike said, you read all the transcripts, or read some of the historical documentation of the Federal Reserve before Volcker. People made fun of the Fed. Nobody listened to the Fed. It was a joke. I mean, the famous article by Edwin Dale in the New York Times in 1969 literally said the Fed is the joke. Nobody paid attention to the Fed. And the only reason we do is because nobody has an answer for why there was a great moderation in the 1990s and 2000s. And Ben Bernanke simply claimed credit for it. He said that we did that by moving the interest rate around a quarter point here or there, maybe sometimes 50 basis points, which is absolutely absurd and ridiculous when you think about it. Not to mention the fact that the evidence shows that that's not the case at all. But because nobody had an explanation for the great moderation, everybody said, well, maybe the Fed is this all-powerful institution that figured out exactly what we're talking about here. They figured out a way to combine all of the right factors and the exact right way that led to this island of prosperity in the latter half of the 20th century, really the last couple decades of the 20th century. And if we just listen to Jay Powell and let him decide for us, we can go back to that perfect place. And it's all basically a lie. It's all just a narrative that was constructed in the absence of useful knowledge. Literacy is at the top of the list.
I think that would be one of the greatest benefits of getting rid of the Fed, because it would increase.
That's what I'm saying. If we get rid of the Fed,
financial education,
we're
because you're not duped into. Well, you're not duped into thinking that the market is going up because the Fed is increasing the amount of bank reserves. So that's if you take away that component, well, now all of a sudden, if the market goes up, people have to educate themselves as to what really drives the market. And then they'd probably land on Mike's theory.
Wizard of Oz head to always
exactly.
about.
Correct. Yeah.
Exactly.
Yeah.
Exactly.
Suddenly you have to think, okay, why are stocks going up? Maybe I should listen to Mike Green a little bit more instead of just thinking that it's because the Fed is printing money. It's in many ways we become lazy because of success, but it's a little bit deeper and more profound.
To me, the Fed is a very lazy explanation for a lot of things. The Great Moderation in the 1990s, I showed you guys the chart in terms of the rising fraction of workers relative to those who are, no longer productively contributing to the system, to use the polite euphemism associated with it. We just have a lazy explanation for the way the world works. And I agree with Jeff. I also think that we have to be very careful about completely ripping off the Band-Aid and recognizing that the uncertainty associated with that. Remember, Kevin McAllister wakes up and he's panicked, right? We don't want panic, because the simple reality is human innovation, human capability is what powers the advancement of our society. It doesn't succeed under massive disruption. Very few innovations occurred in the bombing of Dresden, right? Lots of innovations occurred when you were safely ensconced in Alabama, working in Huntsville and saying, gosh, wouldn't this be a great way to kill people, right? That's really easy to do. It's really hard to do under the disruption that's created under full-out assault. We don't want full-out assault. We also don't want full-out bailouts, right? Both the ramifications of feedback are important.
I agree with you. It could go both ways, though. There could be a situation where you rip the Band-Aid off and it's absolutely horrific. That's absolutely a possibility. But there's maybe an equal or better chance that if you rip the Band-Aid off, it becomes very bad. But necessity being the mother of invention, it leads to exactly the type of reset and the type of innovation that's required to get the system back and moving in the right direction. I think you're discounting the possibility that could be an equal.
I'm actually not discounting the possibility, but if those odds are 50-50 and I'm playing with 8 billion lives, I'm not prepared to take those odds.
And
right?
also,
the simple reality is, if that system breaks, billions of people die. It's just that.
Yeah, but if the system stays intact, Mike, to your earlier point, we're riding on trend that's below trend. And then you get all those negative unseen consequences.
The most glaring of which, George, is the failure of people to reproduce, because they look at the world in front of them. They say, gosh, what's the one way I can raise my purchasing power?
Yeah.
Not have kids.
Yeah. Especially in inflation. Yeah.
Right?
But I think it'd be a lot different than if you rip the Band-Aid off, as opposed to over 5 years, you say, okay, we're going to start just following the 2-year. Or we're just, 2-year minus whatever, 100 basis points or something. And then what we're going to do is we're going to gradually decrease our balance sheet to the point where it's 500 billion. And then once we get it down there, to follow this plan that's predictable, then we're going to go ahead and back out and just let, in 5 years, interest rates be interest rates. And I think that's a lot different than just announcing tomorrow that you're closing shop.
So this was actually tried. That was the underlying dynamic of the long recession that occurred from 1871 until 1879, in which the U.S. tried to withdraw the greenbacks that were printed during the Civil War out of the system on a perpetual basis. It created an 8-year recession in which the economy struggled despite massive increases in immigration. Right? I'm not suggesting that's the wrong answer, George. I just want to be really clear. Like, we have to start making hard choices about how we allocate capital. Right now, we're allocating capital primarily to take care of old people. What we should be doing is allocating capital to take care of young people and create better lives for future American generations.
Yeah. And
Who's
one thing I
gonna
want
make
to point
that
out.
decision, Michael?
I'm sorry, what's that?
Who's going to make that decision? Because I would suggest it's going to be the government.
Unfortunately, not me. I'm an impoverished strategist at a small emerging ETF firm who no one really pays attention to in any meaningful way.
Well, but even the long depression argument, though, that led to the mother of invention. I mean, that's where we got bank ledger money really exploded in the 1860s and 1870s during the greenback period. Banks decided that, national banks in particular, first of all, treasuries were in short supply, so they didn't want to supply physical currency. So they began to really experiment with larger levels of basically bank ledger money. And it led to a long period of prosperity after they solved the short run problem of lack of money in the greenback era.
So I'm going to disagree with you slightly on that, Jeff. I agree with a lot of the points.
Well, you can disagree with the whole thing. That's fine.
No. I actually think you're making some really valid points, but I also think some incredible innovations occurred over that time period. That was also the time period in which limited liability corporations were introduced. It's the same time period in which bankruptcy reform that allowed people to avoid debtor's prison was introduced. It's the same time in which we suddenly decided that we were going to actually introduce elements of banking regulation as compared to the quote unquote free banking era in which any huckster could come along and print their stable coin or their copy pasta token. Oh shit, wait, maybe we're there again.
Of course we are.
Like,
that's history cyclical. Yeah, but you got to, again, we keep coming back to this thing. Yes, you're right. There was tremendous amounts of innovation in every aspect of society, economic, financial, regulation, law, everything else. But it was the missing ingredient in all of those cases is the fact that we have a pliable, flexible monetary system that's best able to take advantage of that combination. I don't think it's an accident that we continue to see human progress take place, maximized human progress take place during periods when debt-based money is the most, I don't want to say it does the best job that it possibly can, but those two things go together. And so in the case of the long depression, you had an experiment in tight money that led to a long depression, but it also led to the solution to the long depression because, again, people were forced to innovate in all spheres. And it led to a situation because the commercial system demanded a monetary system that was flexible enough to allow it to maximize its full potential. And that's exactly what happened. And exactly what happened in the 1950s and 60s with the arrival of the Eurodollar system. So it's, again, we've tried this. Let's do it piecemeal. We've tried this over the last 15 years of let's do a little bit here or there. Let's not touch anything that might be dangerous because it could lead to the worst consequences. And, you know, I kind of take the FDR approach here. FDR was a sound fiscal budgetary hawk kind of guy. And when he came up with the New Deal, he was criticized by everybody. And they basically said, you know, why are you doing this? It could lead to the end of the world or the worst consequences. And FDR basically said, what are you talking about? We're already there. It's 1933 and the world has practically ended that we know it. So let's start experimenting. Let's start ripping some Band-Aids off. And of course, to Mike's point, what FDR did were the exact wrong solutions. So there is the danger of doing it. But we've tried this piecemeal, oh my God, don't touch it type of approach. Maybe it's time for something a little bit more radical.
Yeah, at the end of the day, guys, unfortunately, I am a coward when it comes to my children's lives. And I think that's the underlying status for the vast majority of people. You know, when you think about the dynamics of FDR, there are also the components of the multiple new deals that occurred around the world at that time most of them failed. The United States managed to succeed primarily due to the unique attributes and resources that existed within our country. Right, so it was FDR. This is where, unfortunately, Amity Slaves with her analysis in The Forgotten Man is correct. Right, the United States had incredible leeway to make choices that the rest of the world did not. It's much harder to make choices when you're fighting nationalist forces in Italy or the communists in Germany than it is in the United States, in which those are largely foreign threats.
So why wouldn't it be the same thing today then? Because if we have all of those, we still have those unique advantages. So why not try it again?
I lean in your general direction, and I actually would strongly encourage people to consider the hard choices that would be required to get us there. But I do think it's those hard choices that we ultimately are incapable of making at this point, because as a society, right, this is the classic line from the, Politis, right? Hard times make strong men make good times make weak men. I am a weak man. I care too much about my children. I care too much about my bills. I care too much about my wife to make the choices that might be required.
Well, this is when the martyr comes forth, the Messiah that's willing to die to lead his people out of the desert. This is the classic fourth turning. So this is why somebody near the end of their lifespan is willing to take these wild, radical choices for ill or for well. We'll see who is drawn forth. What
I
kind
don't
of
think
radical
Biden is
will
that
have.
man. No matter how old he is, no matter how old Joe Biden is, and how decrepit and how willing to sacrifice he might be, I just don't see it. No, Emil, this is the risk, right? Because what you're actually creating is a hagiography of a future dictator, right?
Oh, I know. I'm describing
Right, exactly.
FDR. I'm describing Lincoln.
Right.
I'm describing George Washington, who we now look back on
But you're
as
also
saviors and
describing Stalin.
messiahs.
Yes,
You're also describing
see, that's the
Stalin,
thing.
Hitler.
That's
We're
right.
always
All the rest
confronted
of
with that choice. When faced with these circumstances, there's a fork in the road. We could easily go in the wrong direction, which is what Mike's fears are, and I share them. That's definitely a possibility. And if that possibility is substantial, I think I'm with you, Mike. I don't think it's worth taking the chance.
Well,
on the other hand,
we're going to take it.
It's
exactly.
like Japan.
Eventually,
I think
you get to that point where you don't have a choice.
Mike, what do you think Japan should have done in '90?
I think Japan did exactly what it should have done in '90, which is roll over and show its soft underbelly to the United States and accept that it was a supplicant nation.
But you know my point, right? Because the argument there is that because they propped up the banks, they have this zombie economy, and then they go through 20 or whatever
That's
it is,
not the
30
core
years.
issue in Japan. Japan until the mid 2000s actually had GDP per capita that rose more rapidly than the United States. The core issue in Japan was that they created a system in which of course, right? Japan created a system in which the returns to having children were far lower than the returns to simply living. Right, and you see it in China, you see it in the United States today. We have every single society in our world has broadly, with the possible exception of some of the Scandinavian countries, has basically said, "Screw kids, we want to live." Right, we want to live forever. The cult of immortality has taken over. We are so terrified of dying. I got to be honest with you. I'm terrified of living. I don't want to be 500 years old. What a terrible existence. I want to see my children grow. I want to see my grandchildren live. I want to pass on and have ultimately somebody say, gosh, I was really lucky I had such a great dad. Right. And because we are so narcissistic as a society, we're incapable of making those choices. And it's just bizarre.
I agree with Emil here. This is a pendulum thing. I think history or humanity goes through these swings all the time. We get locked into these ideological boxes, and it leads to very real and severe consequences. But eventually, we find our way out of them.
Yeah, and demographics can be a result of the government, with China, with one-child policy, which was a result of them following the path of Malthusians.
Exactly.
Yep. And we're following them as well, right? We preach a giant death cult. The earth is warming. It's our fault. We need to stop all progress, right? That's completely insane.
That's Malthusianism. I call it the Malthusian cult.
Malthusian is giving it too much credit. It's not even rational. It's It's absolute millennialism. It's occurred throughout
It's
history.
nihilism. Yeah.
Nihilism is a byproduct of it, actually. Nihilism is the point that says it doesn't matter, right? Because we're all going to die. But the simple reality is that there are people who are convinced that the answer is that the Earth's carrying capacity is 1.5 billion to 3 billion people, and therefore we need to create conditions under which the remaining 5 billion people disappear. That's just absurd.
Yeah,
right?
but that's the thing. That's a very small minority. What we need to do is create the conditions that make that small minority and reveal it as stupid and ridiculous and counterproductive that it is.
I agree with you, but with a complete lack of education in science, with a complete lack of education in economics, people are terrified, and understandably so.
And that is all Jay Powell's fault. We need to get rid of Jay Powell so that we can get back on track.
And we solve every problem. Anyway, that was a very long diatribe.
Fellas, I think we got to end it here.
Yeah, this was a blast. I really thoroughly enjoyed it.
I
love you all. It was a lot of fun.
Yeah, I cannot thank you all.
And for the person who said defeatism, I got to be honest with you. I am the least defeatist person out there. I genuinely believe the world will be a better place in another 30 or 40 years. Yeah. The technological advancements we're watching, the way the world is changing, the young generation that's emerging, the future sits there. It's there for our taking. We're terrified to let go of it ourselves and hand the world off to them.
Yeah, there's a pathway toward it. We just need to grab it. So thank you very much, fellas. Mike, Emil, George. Thanks to Eric Basmajian, Brent Johnson, Steve for showing up at the bar, Jim Rickards, and thanks again, Josh, for putting everything together. What do you think?
Yeah, I'm in George's studio right now. You're looking unprofessional, George.
Amazing. All right. Take care, everybody.
Take care, everyone.
Thank you, everybody.
Bye, guys.
Goodbye. Thank you. Pleasure.